CAD has, let's go out one more time and zoom out. Okay, we are still in this really long, drawn out consolidation. It's maintaining its press on higher highs and higher lows, and this is one of the times I'm actually going to talk about trend lines here today, and it's something I don't normally talk about, but I want you to see when I look at them and why it's something of significance in certain times. If we look at this, right, we're watching price, and okay, price is going higher, yada yada. Okay, and we've taken out every little short-term high. The next area that I drew your attention to back months ago is this sloppy little high up here. And if you look at that, that comes in here, right in here. Now if we use the bodies or the opening on this candle, that's 132.74. We've already wiped that out. Yeah, we have a high of 33.07. So we've essentially cleaned that out over here. But ultimately, because I'm bullish on dollar, I think that we're probably going to come back up in here and close in this area right here. Now, before I answer what this is, I'm going to ask you rhetorically, what is this? Liquidity void. Now, what is the candle that's up here, the green one? What is its open to low? Fair value gap. Very good, very good. So we're looking for a potential run, long-term dollar CAD to 136.80 to 136.90. But we have to get back through this area over here. Now, we have this down candle right here that came down into a bullish order block. And it's also respecting the middle of this down candle here as well. So what we're going to be watching is we want to see this down candle here. We're going to measure it and divide it in half. The fair value stuff will be more amplified. I'm not going to teach it all here, but I'm just introducing it to you so that way when I give you the tutorial, the teaching tutorial, you'll say, oh yeah, that's what he meant by that because it's in video. I'm just giving you lots of examples of it. But the actual teaching and how to look for it every single time, that'll be in a tutorial, Chris. All right, so we have equilibrium in here. And now here's the cool part. Look at this up candle. You're going to see this happening a lot. This up candle right in here. Look at this candle's low, 132.09. That's exactly at equilibrium of the body of this down move. So see what's happened here? Price is starting to go higher here. Okay, if this is a bullish candle, with it being lower, who buys when the market's going lower? Exactly, smart money, the banks. So as the market's dropping lower and price starts to move higher, even then, even if we anticipate, okay, even if we anticipate this being a bullish order block, okay, or them coming down into a previous order block, okay, so if this is an order block here, right here, if that's an order block and price comes down and hits that, what should we expect on the next day? Higher prices or lower prices? Again, this is a daily chart. Higher prices. But if we watch price go up, okay, and it closes here on this next day here, in other words, price looks like this. Let me get this fib off. That's what your chart would look like the very next day after the order block is traded to, right in here. Here's my question to you. If you're expecting this down candle to be an order block, and we are what? Bullish on CAD. We've been bullish on CAD. We've been calling it higher. If that's the case, the very next day, we would expect bullishness as well, wouldn't we? I mean, if this is a bullish order block and we trade it down into it here, institutional order flow should be drawing price higher, correct? Now, if you are strong in your convictions about whether or not the market's going to go higher or lower, and you look at the higher time frame charts like this, you can do close proximity entries. That means that if you've identified this area as a bullish order block, this range, this down candle, if you define the middle of that candle, and let's just say we're just going to rough eyeball it at 132.05, and I don't know what the actual level was off the top of my head, but we're going to say 132.05 was the middle of that. Okay, I'm just eyeballing it. So 132.05, okay, that's your area. If we add 5 pips to that, and that's what we do, we factor in a 5 pip spread as a buffer. So if we're buying, we're adding 5 pips to whatever level we like, and we subtract 5 pips from whatever level we want to sell. And that way we have a really good chance of getting in. Look what price does right here. The low comes in at 132.09. 132.09. So you would not have gotten your entry using the mean threshold in here, but how rewarding would that be to watch how close it gets to it and not even need the order block to be violated until it does it on this candle right here. This up candle then goes above the down candle, which is the order block. So you know there was real buying in here when this candle's been consumed and violated on the upside of it. But look how cool that is. It gets real close to it. And many times you're going to see sometimes my entries on a higher time frame or a 4-hour chart will give me an opportunity to get in like this. In other words, normal expectation would be, okay, we're going to watch price trade away from that. Well, if we're on a daily chart, that could be hundreds of pips and weeks away, correct? So if you're demanding only that condition, you're going to miss other opportunities by using the higher time frame. The higher time frame chart can be used. Let me double check my time here. We got to go back. Let's watch CAD over here on the lower time frame. All right, the number should be out in a minute or two. We have a liquidity pool down over here, so they may run that. So let's practice that. What's resting below these lows? No, what kind? There you go, sell stops. Very good. Below lows is sell stops. Above highs are buy stops. Remember, it's that market efficiency paradigm. We have to look at the market as a market maker. Where's the liquidity and what kind of liquidity is it? So here's the question. Right now, price is at 132.33, and we have a potential move down to 132.05. Okay. So is that enough of a range for a demo trade for practice? Is it 40 pips? Almost is not. It's got to be 40 pips. If we're going to do it the way I do it, I like to look at a range of 40 pips, because even if I'm wrong about where it ultimately is going to go, if it moves just a half of that, it allows me to get 20 pips paid. So this is one thing that we can just watch and observe. Okay, we know that there's numbers out now. We have a small little void in here. Okay, it might spike up there and then reach for the stops below here. If it runs a little bit more, we would clear out. I wish there was a way for me to take this little goober and put it on the left side of my chart. I have to put it right over top of what my price scale is showing. All right, so we have equal highs in here with another void as well. So if we don't send it lower for these sell stops, we're going to watch and see what they do above here. If they run that, they may make a run to 32.80. Not necessarily 32.80. It can go up to 3278. Yeah, it could go to 3280. 3280 would clear out these equal highs and close in this void a little bit as well. Well, that's a good point. Andreas says it could be frustrating because at this point it can go either way. And that's why we sit on the sidelines. See, the fact that you observe that is good, because if you don't think like that, it's very easy to talk yourself into a trade idea and just jump in there, head first. Yeah, here's the setup. I'm going to get in here and do it. We stay on the sidelines until there's a setup. If you look at the economic calendar, we've actually had a really weird week news front-wise. And there's nothing really that could drive price extremely higher or lower. So there's not a whole lot of like FOMC. There's been a lack of real conviction on the part of investors and traders. So, and the market makes a run on funds. That's what that is. They don't see us, the retail guys. We don't even show up on the radar screen. But there has to be money put to work on the fund level. And if it's not there, then obviously there's going to be a lackluster week, and that's where we're at. It doesn't stay like this long. Question I got is, so why do we wait for the stops to be taken out in a setup first before we look to enter? Because knowing where the market's may reaching for, sometimes it's not going to be that clear to you. And just simply because we came off of a recent high on the daily chart for CAD doesn't mean direction is absolute. And you'll notice that all my setups are either coming back to a previous range or it's a run on stops. They're the only two things that occur for my setup. Well, we wait for the trades to be perfect. Okay, in other words, in terms of setup, the criteria, the more we have in our favor, that's when we take a trade. If it goes beyond 3280, that would be very good for the daily chart. That would continue the upside. The question is if I was trading this live, where would I get in? I wouldn't. There's nothing in this chart that has me wanting to take a trade. All I'm doing is observing where the liquidity pools are and where the ranges are, and you observe. If there was something I wanted to do, I would have did it. There's nothing in here that I want to trade on. All we're doing is observing. And I'll tell you the reason why. Why? Okay, why aren't I interested in taking a trade? Let's say that. Would you like to know why I'm not interested in taking a trade? Like, what keeps me from saying, okay, it's going to do this or do that? Okay, what is my directional basis, or where do I think the dollar's going? Where's my underlying directional bias for higher time frame dollar? I personally believe the dollar's going higher. Correct. Exactly. So if I'm looking at the dollar CAD should see in sympathy higher prices as well. But because of the news that's out right now, it's inventory on crude, which is a direct commodity linked to Canadian dollar or Canada, and it's going to be manipulating its currency, just like the S&P can mess with the Australian dollar. The crude oil market messes a lot of times with the dollar CAD market, and sometimes it causes a little bit of a hiccup in price action, and then ultimately it'll get back in sync with what the dollar's doing. So if I believe that dollar's going higher, and I believe that the dollar CAD's going higher, okay, we recently cleared out a level we have identified, months ago with that old sloppy daily high, and that's what we did here. And we also pierced it a little bit intraday here on a Judas swing, and we went lower, we consolidated, and we dropped down low here. So I don't want to be a buyer here because I don't think we have the range to do anything with it today because we're late. I don't think that we're going to come back up here and clear out the high formed in London because it's formed on a daily chart violation of a previous high. And it's, the dollar's in retracement as well as today. It's too many things against it to be a buyer, for my opinion, and the downside's too limited to get enough range to justify a short. So what I learned in these conditions is if I wait to justify a really low resistance buy on Canadian dollar, then that's what I'm willing to wait for that. Now I'll observe the opportunities on the near term to keep myself plugged into price and be able to get close and feel what price is most likely wanting to do, because I hate to say it like that, it is a knack type thing, but when you watch price enough, you get a feel for it and you know what it wants to most likely do. Because we have the consolidation in here and we have the initial drop down going into the numbers, the daily range is already a bearish day. I don't suspect that we're going to see the high violated, and while we have a little bit of a void in here, I don't necessarily think that we're in a condition, because of the dollar's weakness, I don't think this is a good buy. Because otherwise, let's say we punched down here, right here at the release of the news. Let's say it dropped down immediately right down there. That would have been an exercise to be a turtle soup long, and then look for a run on these equal highs and close in the void. That would have been a scenario that I would be more inclined to do, not buying it down here or selling it up here, because to sell it, I'm against my underlying directional bias based on the higher time frame chart and the dollar. And I understand that the dollar is probably just experiencing a retracement after showing strength the last couple of days. Does that make sense? Do you understand why I'm not inclined to jump in here and just take a trade? Exactly, it's patience, and believe me, it took me a long time to get it. And I don't always exercise it either, though. But the idea of just because we're in the charts and looking at it, and we can talk about specific moves. I know some of you that are new, you're thinking, well, if I can make 15 pips, let me make 15 pips. And you're all welcome to do whatever you want to do. You do whatever you want to do. I'm not here, telling you what to do with your money. I'm just telling you what I'm willing to do and what I'm not willing to do. And because of the parameters that's been shown here, I'm not really that excited. In fact, we could have just priced in the low ahead of the numbers and say we just come back up to here and then we consolidate going into the close. How's that a trading opportunity? You're trading your time for nothing. Whereas right now, we already have the news out. It didn't take the stops above the equal highs yet, which is not good, because if it's going to run up there, it does it really quickly, and it won't give those traders an opportunity to do anything about it. They'll run up there, clear them, and trade lower. Or run up there and close the void and then trade lower. Think about the market profiles that I gave you templates for, okay, in free, I think I did it. Where did I do that at? I did a video. I can't remember what video it is off the top of my head, but it was during all the free tutorial stuff. And I gave specific conditions for certain daily templates, what the daily range is usually form under in terms of price action. This one here, okay, it could be it's a run initially at London, down day, then go into consolidation. So it's a London swing to consolidation day. And it doesn't make sense for that to be like that. If it's going to be anything, it's going to be a consolidation and then swing into New York or London close because of the crude oil inventory numbers. That would make sense. But because, yeah, exactly, London swing to Z day. Basically, it's a consolidation, same thing. But because it doesn't fit the criteria and we don't have much time, a day left, it's not a profile I want to trade in because we've already seen the money move already for the day from London. So now we're in a consolidation. This thing can only just tread water going into the close and frustrate you like it did me before I realized what I was doing. So it's been a bit of a consolidation. And I think, honestly, because of the FOMC and because of the shock waves that came by way of the British pound this week, there's a lot of money on the sidelines. They're like, what the hell just happened? We're all waiting for the next shoe to drop. And when that happens, it puts money to sleep real fast. It's a lullaby on large funds. So what we'll have to do is we have to sit and wait, and the conditions will open up. You just got to wait for the daily charts to get where they need to go for another reactionary high or low. How would I trade the London Open on this pair, on CAD? Well, obviously, I mean, it's all. I didn't do anything with it, and to talk about it really wouldn't be all that, in my opinion, that educational, because it would be just like anything else. You could look at the chart and know what I already teach and justify all those things. That's a good question. Jacob says, what do you consider when you have two liquidity voids back to back, like the cable had? Well, can you give me the time frame you're talking about? That way I can pull it up on the chart. Yeah, give me a time frame. Give me a chart. 15-minute, hour. Give me a specific chart to look at, and I'll answer your question. 15-minute cable. Okay. All right. So, well, where's the other void at? Because we have this one here. Now, I'm assuming you knew that one because we were just talking about. But where's the contrarian liquidity void? This one here. Well, we came down. Well, this whole thing here was nobody's doing anything with this. It already ran its low. It just took off and went lower. The point is I think your question is how to contend with this and then this over here. Like, how do you use this information? Is this beneficial to us when it's like this in close proximity? Is that what you're asking? It just doubles up the likelihood of fair value. In other words, we've seen price delivered on the downside, and then it came quickly back through it again over here. So while we spent the majority of the time down here, it gapped to get down to that level quickly, and then it gapped up away from this level down here. So that's why I'm saying I think that they have accumulated longs down here, and they will permit a drop down, but then ultimately make a run above here. That's what I personally believe. They can do this too. They can do a run up, clear this short-term high, stop it dead in its tracks there, then send it lower, take that low out, and then ultimately come back up here and take that out again. And then longer term, go lower. But to answer your question, not to sound like I'm sidetracking it, when we have a liquidity void going low and it closes in, this entire range in here, let me do this. More specifically, this right there. Notice how this candle stops at that low, and then this candle opens here and trades down. So I'm putting the range at this candle's low because there's two candles that traded inside this little small little space. You understand that? Why I'm using this whole shaded area in here, because it's two candles that traded from that low, well, this candle, and up. So I don't want to use that. I want to use below that and above this candle's wicks high. So we've identified at which there are very little trading going on. Because it happened in two passes quickly here and here, this whole price range in here can be revisited again. Contrary, or conversely, let's say it like this, if I would have saw price come down lethargically and more up and down, up and down, up and down as it went lower, and then it created this here, then this entire range would be expected to close in. But because we have this here, watch what happens. I'm just going to borrow this level. All I'm doing is using this the high here to form a low end of the range right in here, identifying this whole area here. So this is all fair value still. This is all fair value. Price comes down into it here, runs away, comes right down into that candle's high right there. The high comes in at 121.62. This candle's low comes in at 121.63. We're one pip away from it. And look at the work around that level. We have a down candle, which is a bullish order block. It's violated here. Price comes back down. Look at the bodies, how they're respecting that level. We've cleared fair value. We spent all that time in here filling it in. Have we run aggressively from it higher? Yes, it would be still, in my opinion, it's still a void. Even though it's been passed through twice, it's done so with big ranges. So it's going to want to close in that. You think that's a strong willingness move away from that level? I see it moving away from it, respecting it, but I don't see a dynamic price surge away from that. No, I don't see that at all. And in fact, we've not shown any willingness to go higher yet. It could, but I don't see it yet. So to answer in complete terms, whenever price drops down through a range of price, and the range would be whatever this low is on this candle here. Let me do it like this so you guys can see it. This is a range in price that both I didn't want to do that. So between this high and this low, and I'm referencing this down candle's low and this up candle's high. These two candles here are big ranges. Price did not have a lot of time to trade through the 121.89 to 121.61 on the down move. It did not have that much time to trade through 121.61 to 121.89 on the up move. So we have a big range, well, not really big, it's only like 20 pips, 25 pips or so, that's going to be offered as fair value. They're going to want to come back down into that range, okay, and give the market more opportunity to trade there. And you see that over here. Ultimately, it did come down and close in its void, but whenever you see back-to-back areas of where price just runs through up and then runs down through it again, you still want to reference that area because it's going to want to come back to it later on. How did I undo the mistake I did by deleting something? hold down Control and tap Z. It'll, like, I'm going to delete that. If I hold down Control and tap Z, it puts it back. Okay, here we go. Remember, what are we looking for? What side of the liquidity were we looking for? Now, why would I be more inclined to look for these down here and not a run above the high? What was priced in over here and what time of day? London. Okay, so we went into New York time period. Was New York's open higher or lower than the trading session that was formed in London? It was lower. So the daily bias in New York is what direction for UsCad? Going down. So if it's going to be a down day, the easy thing to do is look for where the sell stops are, because the market's only going to go down to an area where there's going to be willing participants to sell at a lower price. Why do they want to aim for the lower prices, below previous lows? Because those liquidities that are offered in the form of sell stops, how does smart money use that? They buy it back from their sale. Exactly. They're pairing of orders. Exactly. That's actually a good question. Let me bring that one up. All right, Hezron says, if the algo is responsible for price delivery, what is the relationship to commercial players via COT, Commitment Traders Report, or is it that the commercial position themselves knowing what the algo will do? I'm not going to say that the commercial traders know what the algo is going to do, because most people aren't even aware there is an algorithm that delivers price. They think it's all supply and demand, or the fact that buying creates higher prices or selling creates lower prices. That's not the case at all. Price is being manipulated and delivered by way of the central bank policy and what they want to establish in terms of macro trend. In between these reference points long term, the bank operates on a model that facilitates free trade illusion. Okay, but in reality what they're really doing is they're providing liquidity, but there's a method behind it. And what I'm teaching is not germane to commitment traders or the traders that hold reportable sizes that would be referenced on those reports. Completely isolated to different thing, completely distant from one another. So don't think that that has anything to do with each other. They don't. There is usefulness in the COT, but it doesn't have anything to do with the algorithm. My pleasure. Could we have a trade idea to sell this turtle soup on the open because it's Thursday, possible reversal day? I kind of want to refrain from talking about hindsight stuff because you're in here learning, and I can show you charts like that, but I don't want to talk about hindsight in live sessions. I really want to talk about what's going to happen going forward. That's why we're eyeballing those sell stops below there. That's the direction I called for. That's the direction I think it's going to go to, and I think it's the level we're going to probably see. So talking about what happened in London is not as fruitful as watching what's going to happen, before it happens. I guess, good question. Can a retail trader trade through a prime broker, or is that just for institutions? When you trade via a prime brokerage, you have to have millions of dollars and a really good credit score, and you have to have a good track record. So eventually, everyone that trades through it was eventually, well, sometime a retail trader. No one just starts as a prime brokerage. They just don't let anybody through the doors. Okay, I'm not going to say your name, but you're going to know who it is that said this. Mike, I am taking too many stupid trades. Please help me. Okay, I'm going to refer you back to the first instruction. Okay, that means stop trading. You should not be doing any trading right now. At least, very minimum, the first 6 months. And I know that's not going to be easy for some of you because you want to make money. But the whole prerequisite to this thing was that you don't trade. You have to stop trading and learn. The important thing is you want to be able to look at the charts very quickly. This is how you know you're ready to trade with live funds. And I'm not going to tell you when it's time for you to do it, but I'm going to tell you how you'll know. Okay, so put this in your notes today. This is the takeaway, okay? All of you are here to learn how to trade your own money. You're not going to ask me what I think the market's going to do. You're not going to be on Twitter asking what everybody else with the most Twitter followers thinks about gold or pork bellies. Not that they don't trade them anymore, but you're not going to care about anybody else's opinion. The way you know you're going to be ready to trade your own funds is when you're able to sit down in front of the charts and within minutes know exactly, is there something to trade? If there is something to trade, what's the risk on that trade? Okay, that's the first thing you define. Now, can I take a trade with that risk? Even if I know the market's going to go to a specific level, can I frame a trade that makes sense logically with risk parameters outlined before I even think about the money? If it doesn't give you good risk models, there's no trade. But if you can quickly go into the marketplace on any given day, go right in there and quickly discern, okay, there's an opportunity. The risk is defined to this. I can get a multiple of 3 or more, preferably 3 or more. At the end of this mentorship, you're going to be looking at 5-to-1 setups only. And that reduces your frequency of trade. And that's going to go against what some of you all want to do. You all want to trade every single day. Sometimes you want to trade twice. You want to trade London. You want to trade New York. Believe me, I know what that feels like. I did the same stuff. But the way you know you graduate into knowing when to trade with live funds is when you can consistently, for at least 3 months, consistently sit down and observe the market and say, okay, I have a setup, and then execute on it. Either it pays out profitably on a demo, or it hits a stop that was reasonable, and because you're going to take losses, it's going to happen. You're going to see me take a loss. It's going to happen, so prepare yourself for it. But your losses will be small and manageable, and they're not going to undo your mental state about what you're doing as a trader. Or you're going to discern there's nothing to do, and you're consistently able to find setups that pay out with low risk, multiples of 3 or more in reward, and you can do this for at least 3 months after you have discerned what type of trader you're going to be. Then and only then, contemplate putting money in. Then only, not anybody else telling you that you're ready. Because then you'll know what it feels like to be consistent about what you're looking for. And believe me, that's why we have the live sessions that show that we can read where price is most likely going to reach for. And if you continuously program yourself to look at that every single trading day and you use a higher time frame chart, then it will help you get to that conclusion sooner. And it's not a rush to get to live trading, but you want to know that you're doing it systematically and methodically and not just rushing to get in there and gambling. And the worst thing you can possibly do is get a groove on and get in alignment with what we're expecting in charts and watch them unfold and say, okay, I need to help pay for this mentorship. I need to get my $150 back. Because if that's weighing on you, you probably should have never signed up for this. That's why I said if you have to get a job, deliver pizza, do whatever you got to do. There's no shame in that. Do what you got to do to get your education. Once you get it, you can't forget it. I can't take it back from you. Once you learn this, I can't say, well, I'm sorry I taught you. Can you give that back to me? No, it's yours. Once you obtain it, you have it. Yes, the question is there a 5-to-1 setup each week? Absolutely, every single week. They're the ones I load up on. They're like my one-shot, one-kill setups, and that's the primary focus of this mentorship. Whether you're a day trader or a position trader or not, the takeaway is you won't need to be a day trader. You won't need to do that, but you will be excellent at it. You'll be able to do extremely, very, very well as a day trader, which is crazy because most people will tell you that day trading, nobody makes money day trading, and I laugh at that. Even my mentor, Larry Williams, he says, I've made a lot of money day trading, but I've never seen anybody consistently be able to do it. Well, we're doing it every single day. We're calling the market every single time we sit in the charts. We call at a specific level, and we identify whether there's a real trade there or not, okay? But long and short of it is, you're not going to sit down every single day and trade. And to have that mindset in this mentorship, you're going against the intended purpose of your education. You're trying to learn how to trade when the quality setups are there, not how many trades you can prove you traded profitably. It's much better to be able to sit and wait for a setup that has so many things going for it than to sit there and say, well, I'm taking a trade today because, I have time and I got time all week. And I could be in there on London. I can be in there, No, the question was from ProCharged Mopar. Was there a set, or is there a setup 5-to-1 each trading week? And I said yes. That's the context of the one-shot, one-kill. So anyway, the point is, we're not trying to trade just for the sake of trading. We're only putting our money at risk when it makes the most sense, and we have velocity. You have to have velocity behind your money. Otherwise, it takes time for that money to come back to you, to return back to a riskless state. The majority of your time, your money will be in a riskless state. That means it's not at work. And you're only putting it to work when it's highly probable. And that goes against what everyone else does in trading. Everyone else trades every single day. Or they're trying to force a trade because they have time, their availability, their day off. They've taken a day off or two. I've slotted some time in, Michael. I'm gonna put some practice time in, and I expect to make some money trading. But that's not how this is going to work. And that's all part of a myopic viewpoint that needs to graduate into a more mature view on how the markets operate. The market's not going to submit itself to your schedule. It's not going to. You need to submit yourself to its schedule. And when price releases and it trades where we want it to go, it's going to happen on its own time frame. It's not going to happen because you want it to. You have to study it and observe it before it gets to the point at which it becomes second nature. You won't think about it anymore. It'll just happen. You won't force it. You won't require anybody else to support your idea. You won't ask me, hey, I'm looking at this, and do you think this is a good trade? If you're doing that, or even think to do that, don't do that, because you're actually stunting your growth. You don't want me to help you right when you're wanting to ask the question about, is this a time to take a trade? That's when you're going to do your greatest learning. There you go. It just happened again right in front of you. Now, it's not a big move. That's not a big move, but the fact that we're able to read where the market makers will reprice to, even on a small scale, the only thing you're going to end up doing is taking these same things and apply them to a longer term chart, an hourly chart or a 4-hour chart and a daily chart. And you're going to use all these specific criteria that I give you, and we'll end up fleshing it out into a specific flow chart where you'll do this at the beginning. You'll have a decision. Okay, do I do this or do I do that? If there's criteria isn't met, then you just go to the next stage. Then you watch the next decision point. Okay, do I do anything here? If there isn't anything to do, you wait. If it kills the trade, then you go back to square one. You go back to the original decision. Do I do anything? If there's nothing to trade on, then you wait. But each process, each individual process has its own reasons for being considered. And it's binary. It's either you do or you don't. And when you get to that thinking process where you're not requiring a whole lot in parts of, like for instance, if we had the folks that are all still in the free section area of my stuff, the people that never joined this mentorship, if we could all get in a room together, okay, and then we could all segregate ourselves. Okay, this is the side of the room that has the mentorship, and the other side which will be the majority, the thousands that didn't join, which I'm glad because I couldn't be able to deal with it. Can you imagine if we would have had 6,000 people in here? I would have blown my brains out. I just would have done it. I never would have been able to talk to you today. I would be a mess. But let's assume for a moment that we had 6,000 people on the other side of the room, okay, and you 800 people are on the left side of the room. Okay, now, if I was to ask you all, do I have a lot of things that I use when I trade? The people that are stuck in the mentorship, okay, right now will know that how many things are you seeing me talk about, like when we talk about this move here? Did I pull up a myriad of things that I talk about in terms of the free mentorship? What tool did I use? Was there a Trinity used here? Was there any pivot points? I focused on price action. That's all I did. I gave you institutional order flow and where the market maker is going to take price and why I don't believe it was going to go up. I told you it was going to go down. I explained it to you in as clear as I could without adding other things to it. Now, there's other things that you're going to learn to help me get to that point. And it'll help you too. But eventually, you won't need those things. They're just going to be things in the way. You want to be looking at price. Okay? So when you're in the mentorship, you're going to see that we will refer to all those same tools that were shared in the free membership stuff, all those free tutorials. We're going to reference those things. But you're going to see that I'm not relying on that stuff every single day. Like that trader's checklist when you went through the trading plan, you probably looked at that trading checklist and you're like, what the hell? I got to do all this? I'd rather just stick on a indicator and just let me let me focus on that. That's a lot of stuff. But you'd be surprised that checklist. I did that whole entire checklist when I looked at the price action while I was talking to you. It just went through the whole process of me thinking about it. That's all I did. I just went through all of those same things, but I did it in such a quick speed because I've been doing it for so long. And that same thing's going to happen for you. So while there's a ton of information and there's a ton of tools and concepts, your brain, because you'll think like a flow chart, you'll go from one position of decision or lack of decision. Okay. In other words, if there's nothing to do, you wait. If there's something to do, then you execute and you move to the next stage. Okay, do I take a trade now? Okay, well, where's the risk at? If the risk is X, Y, Z, and it's beyond what your normal parameters are, then you go back to the original state. You can't take any trade. But if it meets the risk criteria, then the next stage is, okay, where would my first target be? Can I cut my risk in half at first target? Because that's the goal. So whatever you're risking on your trade, if you can't take first profit and reduce the risk in half, at that point, it's not a good trade. And I don't give a shit how far away the ultimate objective is. If you can't take first profit and remove half the risk off at first profit, that's not a good trade. Now, there's a checklist that I'm talking about here that is in the trading plan decision, not trading plan decision, trading plan development module. I have it's in my free tutorials website. I can tell you there's a lot of information on that, okay? And you're welcome to go look at that and take a look at it and all that business, okay? But the mentorship is a fast track all through that. So you're welcome to go watch that one, but I'm just going to give you an abbreviated view of it and application of it because there's a lot of things that are necessary. But as a new trader, it is necessary because you need to think like that initially. But it's a lot of work. But I can just tell you about people that watched it, they were thinking, what the hell? That's a lot of stuff. And it requires work. And lazy makes no money in trading. Write that in your book today, in your notes. Lazy makes zero money. It doesn't happen. So when you look at those things that I give you in that trading plan development, that checklist, that all happens in minutes. But it feels like, I've missed a trade by then. By going through all that checklist, by then the market's already moved. And it probably is if you're trading on a 1-minute chart. And that's why we don't trade on a 1-minute chart. We use an executable time frame. 15 minutes is a good trading time frame for a day trade because it gives you time to watch the setup pan out. I'm getting a million questions. Can I have the checklist now? The checklist is mentioned in the trading plan development, but that's not the mentorship flowchart thing you're going to get in August 2017. But it's meant as a new trader how you should start thinking on a basis of decision. You know, when you look at a trade, it's too easy to say, okay, it's going up. It's been going up for 150 pips. I got to buy it now because it's going to go up now at least another 900 pips. It's been going up 100, so it has to go up another 900. It can't retrace. It's got to go straight up from here, so I'm going to buy it. And that's what I did too as a new trader. When I was trading commodities, I would watch these markets take off, and I would watch it keep going and keep going. I'm like, man, I got to get in there, and I would buy the high. So the point is, it's not necessary for you to be in here every single trading day trading live funds. In fact, I've already told several of you, and you know who you are, that you're struggling because you're trying to force something to happen just because you're in here. Don't do that. You're in here to learn. Nobody goes into the medical field to be a surgeon, and on the first day of school, they don't place a scalpel in their hands and say, hey, look, Tom just fell asleep next to you. See if you can do an appendectomy on him. See how long you can get that. See how fast you can get that done before he wakes up. You know, it doesn't work. You can't do those types of things. So you don't know what you're doing yet as a trader, and just simply because you're in the same realm, we're talking and we're exchanging ideas and you're learning, it doesn't mean that you're absolutely ready to go in here and start taking trades. And some of you are encountering that, and you're not listening. So please let me gently remind you again. You're paying for me to teach you. I have done this a long, long time. I have taught people for the last 12 years, okay, that have learned a great deal of what you're learning now. I started teaching well before I should have in the late 90s. I didn't know as much as I thought I did. Over the last 12 years, I can tell you I have learned more about the markets than any other time. If you trust me enough to pay me money, trust me enough when I tell you, please don't trade. Don't. Because you're not going to help yourself, you're not going to learn, and you're not going to take advantage of the time we have together. For the 12 months is going to go by quickly. It's going to go by quickly. And if you waste it trying to make money, rushing, you're going to waste the wonderful opportunity, because I'm not doing this again. It's not happening again. So use this to your advantage. Take the whole aspect of money out of it. Don't worry about that money. I'm telling you, the money is easy to make once you know what you're doing, and it comes very quickly, and you don't need to risk a lot of it. But some of you folks are just so geared up. You want to trade, okay, and you have to do it now. You got to get that $150 back. You got to make money now. You feel like you're wasting your time. You need to stop thinking that way. Believe me, I have your best intentions in mind. If you trust me, then trust me. I will get you where you want to be at, and you won't require me to handhold you anymore. You won't look for anybody else to help you. You'll be confident about what it is that you're going to do. But I have to take you through a process that takes time, and it's going to require you to listen to me. And if you don't listen, it's not me not being able to teach you. It's you not listening to the instructions. And the first instruction was no trading. You have to do this. If you don't, you're going to waste your money and you're going to waste your time. And that's a terrible feeling, especially when I'm going to be showing you exactly what you should be doing. So I'm going to close that. I'm going to close this session on that note, and just understand that there is all the learning that's ahead of you will happen. It'll happen on its own, but you got to let me take you through it. There's a process that you have to go through, and even if you don't agree with it, trust me, you're on the outside looking in, and I was exactly where you are right now. And what I thought I needed to know, I didn't. And what I needed to know, I had no understanding about what it was. I am on the inside, and I'm telling you, my perspective is clear. I don't need to worry about it anymore because I understand. I understand how you feel, but trust me when I'm telling you, relax. Just relax and let this whole process take its course. Even when I'm done delivering the content, I will be here for an entire month every single day. And the whole time will be us spending. The whole New York session, the whole London session. When I sit down with you, I will be there for hours. And I will answer anything that comes up. And anything that comes up that entire month, there won't be any more content. It'll just be my time and answering everything that comes up to me in question. So trust me, I'm not going to leave you high and dry, even just simply because I give you the content. I'm not going to vanish. So just settle down. Just relax and let me do what I promised I was going to do. But you have to hold your end of the bargain up too. That means don't trade with live funds. Don't do it. I don't want you doing things ahead of what was the intended course. Don't do that, because you're not going to learn as well as you would have if you just would have listened. Is that fair enough? Okay. So before I close it, did the dollar CAD go right where we were talking to in regards to the stops? Did it close in that liquidity void up there at 32.80? Did it come up in here and trade into that that bearish order block in here? We went through it, but didn't it come up into that area here? And then an expansion, because where are we at in here? When price was up into this point here, price was where? Think like the algo. Consolidation, right? Consolidation. What happens after consolidation? Expansion. Where is it going to expand? To liquidity. Once it gets that liquidity, then what's going to happen? What can happen? Once expansion happens, what's the next two phases that can only occur? A change in direction or a consolidation. They're the only two things that can happen. So once we get to a liquidity pool, we either expect it to retrace in the form of a reversal or retracement, or goes into consolidation. Even if it's going to continue going lower, we anticipate that. That's the same thing that the algo does. Okay? So I'm going to close this. Wish you all a very pleasant afternoon, evening, morning, wherever you're at. And I sincerely thank you for your patience, and I apologize to those individuals that were uncomfortable over the last 24 hours. I got to get the folks out of here that are freeloading. That's all. That's all I'm trying to do. So I hope you can appreciate that. You're paying for it, and why should they get a free ride? They have the ability to pay for it as well. So I will probably send you some charts tonight through Twitter. I am exhausted, admittedly, though, so I wanted to spend a little bit of time with you and give you something to watch real time today. So again, we have one more exercise where we saw it happen today. Not a ton of pips, not a million pips, but something that's measurable that we can forecast that happens. And because we're using lower time frames, it gives me a lot of examples to show you. So I'm going to close it. Wish you very well, and I'll check back with you on Twitter. And I don't foresee any locking down of the forum going forward. I think I pretty much got that now. So yeah, I think we're out of the clear in that regards. Just as one more reminder before I close, the username and password that you have right now is the same one everyone's using. Okay, don't share it. Don't give it to people. Okay, in November 1st, when you make your payment, I'm going to reply with when your payment is received by me, the PayPal address that's linked to PayPal, your email address, I'm going to send you a request for your satisfaction on month 2 and a resubmitting of your agreement to the terms of use. Your agreement has to be on that, and you have to show me that you're satisfied. If you do not do that, I'm rejecting your payment and you're being removed, because we're going into month 3 and it's a whole lot of setups. There's a whole lot of actually getting in here and doing this stuff. And I don't want anyone in here without having agreed to the terms and without showing satisfaction and agreement that month 2 and month 1 was to your satisfaction. And I already know some of you that are very cynical are going to remind me, it was okay, but I didn't like the fact that I got locked out for that one day. I already know that's coming, okay? And it was intended to protect the content, to preserve the integrity of the content. So I can see you asking for the PDF files. The PDF files come in the way of the tutorials, okay? Those teaching tutorials, they all will have PDF files, okay? So I'm going to close it here. Wish you all very well. Thank you very much for your time. I hope this was insightful. Until I talk to you again, good luck and good paper trading.